bailout is a middle-class good.
We're only trying to fix the last crisis, to try and design risk out of the system. This is ultimately futile.
What is at the root of every single crisis? It is the self-preservation behavior of people like you.
It's very good to know that I've been responsible for all world crises.
I did not say it that way. Almost all big events in finance are at the root political and not caused by market participants.
It's the vast majority of people who don't have access to these kind of investments who actually have to pay in the end through higher taxes.
The proliferation of AI is likely to increase the systemic risk rather than decrease it.
I promise you two things. A, there will be a crisis, and B, it will be different in detail than any previous crisis.
Welcome to Capital Horizons, the podcast where money meets politics. I'm Igor Yelnik, this is Sir Michael Fallon, and today we're joined by Jon Danielsson, Director of the Systemic Risk Centre at the London School of Economics. Hello, Jon. Thank you very much for joining us.
The pleasure is all mine. Looking forward to this.
Okay, so you are in charge of the Systemic Risk Centre. So what is the risk for you?
Well, the risk to me is I'm interested in a systemic risk, which is the risk of really significant catastrophic events that probably or hopefully never happen. So I'm not interested in day-to-day risk. I am interested in the chance of a financial crisis hitting the United Kingdom, or perhaps a real estate crisis, or someone not getting a pension. To me, that is risk, what is really important. And for most people, that's all that matters. Day-to-day risk is not all that important for the vast majority of human beings.
What's the borderline between the day-to-day risk and the catastrophic risk, systemic risk? When you have bonds falling by 10% in a couple of days in September 22, is it a catastrophic risk?
So it all depends, and this is a really interesting comparison you brought up. So if you take the stock market, most of us who are invested in the stock market, we are prepared for a 10% stock market drop. And the risk we sort of are prepared for and we expect and anticipate, we might not like it, but it's not a serious event for most people. Even in 1987, the global stock market fell by 23% in one day, and nothing really bad happened. And that is because the stock market is essentially a known unknown risk. It is something we anticipate.
I will disagree with you. I remember that day in the end of October 1997 very well. I was sitting in a hotel in Amsterdam and was watching the stock market fall like minute by minute. And I was thinking about my portfolio at that time. I didn't like it.
No, but that's a different thing. I mean, if you had held on and if you had just watched it, of course, I mean, you see that you're losing 10% or 20% of your stock market investments. It's not a nice thing, but it's not a catastrophic thing. And the market recovered quite quickly. There were no real economic consequences from that. So essentially, it was a one-day drop in a market where we expect large drops. And for most people, it had no material impact. Market recovered in a few months anyways.
Yeah, sure. But then in the middle of March 2020, the market fell by 10-12% in one day in the middle of March, right? And then the Fed pumped so much liquidity into the market that probably it was a little bit worried.
So I think the Fed made a very big mistake, and the Bank of England made a very big mistake in March 2020. They were looking at the events, and they had 2008 at the back of their minds. And often to the financial authorities, they see a crisis and they think all crises are the same, and therefore we should respond to all crises in the same way. 2008 was a crisis caused by market participants misbehaving and taking on excessive risk. We call this endogenous risk because it's the risk that's created by the interaction of all the people who make up the system. COVID hit a financial system that was quite well capitalized at a relatively low risk, and the system was in a very good shape for absorbing the shock. So therefore, by the Fed and the other central banks intervening and pumping liquidity, they created the conditions for the very high inflation that hit us a year and a half later, which created quite a lot of systemic risk.
But do you really subscribe to the theory that the global financial crisis was actually caused by the actions of the market participants? Or was the system tuned in such a way that it incentivized a certain behavior? People borrowed money, bought houses, borrowed more, bought more houses, and oops, all of a sudden you have a housing crisis.
No, of course, no, you are exactly correct. The difference is that the 2008 was caused by the system itself within the system, while 2020 was what came from outside. And the roots of the 2008 crisis were ultimately political. And I think almost all big events in finance are at the root political and not caused by market participants. Because the reason is the US government in 1974 decided that they wanted houses for poor people. They allowed the subprime market to emerge. And when the US authorities tried to prevent the excesses in the early 2000s, both parties, and this is the one place where the far left and the far right came together in the US Congress to block anything that would prevent that market from growing. So ultimately, 2008 was created by politicians creating conditions that market participants or the traders then took advantage of to a rather disastrous effect.
Yeah, I think you're absolutely right about this. And I've heard your podcast on the weaknesses of macroprudential regulation. And I think you must be right that the essential weakness, it can try and design out risk and move it around and try and eliminate diversity, but it can't deal with the political risk in the end of the day. Before the markets were opened up, when you had a handful of people investing in Lloyd's, fine, their syndicate went wrong, then they had to pay. But when you have hundreds of thousands of people making investments in a particular bank, then of course the risk is socialized. And it seems to me all the efforts to design effective macroprudential regulation will fall on the fact that the markets are so democratized now that people expect somebody else to pick up the mistakes.
No, you're exactly correct. One of my LSE colleagues, he's been looking at this, and he says that bailout is a middle-class good because the middle class sees the crisis coming and they demand the government do something. But this happens again and again and again. So all of it happened in past crises. And I call this the fundamental weakness of the macroprudential agenda, which is that you cannot have an unelected bureaucrat sitting in the Bank of England regulate the behavior or the conduct of the Chancellor of the Exchequer or the Prime Minister. It is not acceptable in a democratic society because the central bank ultimately is a non-democratic institution. But if the roots of the crisis or the biggest problems are caused by the politicians, then it's an unregulatable type of behavior. So what you end up is the Bank of England and the other macro-pro authorities regulating what they can regulate, but because they have to leave out the biggest risk factors, it's a very big ingredient in my illusion of control.
Exactly.
Yeah, but is it the problem of Bank of England or any other central bank's officials to be unelected? Actually, if you are elected, you are fighting for the median voter. And the median voter is exactly the person you want to take care of, and therefore you don't want him to go bankrupt. Therefore, you're going to do exactly the same thing, exactly because, not despite, exactly because you are an elected official.
No, you're exactly correct. And if you go back to the 1950s in the United Kingdom, the policy regime was called the stop-and-go policy regime. The Treasury decided on interest rates, and they would lower interest rates 6 months before election to create a boom, and then step on interest rates right after whatever party won. And therefore, the economy would go from boom to bust because of political-driven interest rate decisions. And the reason why we have independent central banks is because of inflation. But there's one important distinction here. Monetary policy is unique because we can monitor directly whether this Bank of England is doing its job properly. We know the interest rates, we know the inflation rate, we know the policy tools, the price and quantity of money. So it's something we can directly monitor, and therefore, because of that, we can delegate the authority to the policy authority. Macro-pros are diffuse, very imprecise, very unclear policy domain. Take monetary policy. If the Bank of England raises rates, It affects everybody in the country to some extent. When you do macro-pru, you are targeting almost individuals. And therefore, because macro-pru is ultimately much more political because it affects individuals and regions very directly, and it's imprecise, we don't really know how it works. It operates with a lag, and the causal chain is unclear. Therefore, it is not really suitable to an independent policy authority. But then if you come back and say, okay, let's let the politicians run it, we are not going to end up with a better system. So this is why I think we need something different. Instead of regulating the way we do now, we need a different approach to regulation. So if you are anybody who invests in financial markets knows the principle of diversification. Or if you're not in finance, don't put your eggs into the same basket. That is, and if you invest in equity markets, you buy a diversified portfolio of stocks, you might buy bonds, you might buy commodities, so that if one thing fails, then you are protected. This is the basic principle of finance. And there's no reason why we couldn't use the same principle for regulation. Because what happens now is, and what is increasingly happening, is that we treat every bank and every market participant as in the same way. We force them to see risk in the same way, because that's what the regulations say. We force them to react to shocks in the same way, because that's what the regulations say. But if you end up with the banks and other institutions that see the world and react to it in the same way, you're reducing diversification. You make them behave as a herd. You amplify the cycle on its way up and on its way down. And the solution to that is exactly what every investor knows, is diversification. If the authority, if the Financial Conduct Authority, the PRA, and the Bank of England actively encouraged diversity instead of just paying lip service like they do now, and they allowed people with new innovative ideas who want to do something different, make it easy for them to set up shop and run their businesses, you end up with financial institutions that see the world differently, react to it differently, and it's a win-win-win situation. You end up with better service to clients, you end up with a more stable financial system, and one that is cheaper than we have now. And that also reduces the impact of the political difficulty with regulations, which is nobody's fault in a way, but it is caused by inherent, I think, design flaws in how we regulate.
But it seems to me that this idea is politically untenable, because it's very easy to say, now we have introduced this new beautiful regulation which is going to improve the system, rather than to say, now we are going to diversify because we actually don't know how to create one good regulation for everyone.
No, I disagree. I don't think it's politically untenable. And I suspect a lot of politicians would find the idea very attractive if they looked at it. And a lot of participants in the political system. Well, there are two parts to this game that dislike it. One is the incumbents, and the other is the regulators. The incumbents dislike it because it means competition, which reduces profits. And the regulators, it makes their life more difficult since they have to work harder at regulating. And that's the real opposition to this. But politically, I think this is easy to explain, and the idea is entirely logical.
And the benefits there, I think, for politicians in terms of reducing the cost of the whole sector, but also of stimulating economic growth by backing diversity. If politicians, I think, understood that more clearly and the cost of all this was more transparent, then I think you'd have some more takers from slowly moving away from macro-pru.
No, I think exactly right. And the United Kingdom has always been a leader in financial regulatory thinking. Even to this day, when you deal with the authorities abroad, they look at the Bank of England as leaders in thought in this domain. And therefore, if the authorities here decided to do that and they got the political support to do it, I think to significantly strengthen this country and its already existing, even though slightly eroding leadership in this type of thought.
I presume that you've been explaining this idea to politicians and regulators for many years now, and nevertheless, I haven't seen a significant move in the right direction. Financial institutions are becoming bigger and bigger, regulations getting tougher and tougher, so actually I think the train is moving in the opposite direction.
You are exactly correct. I mean, I think one of the big problems is that, and if you allow me to excessively simplify the debate, most people who deal with regulations, they don't understand the technicalities, and they don't want to understand the technicalities because you can hide behind your lack of knowledge. So you end up with people running the system that refer to the technocrats, but the technical experts might not understand the real world. So they see the models doing something, and you can create a nice theoretic quantitative model that makes this regime the best. They inform the people at the top, well, then happy to embrace that. So it is a difficult thing to sell. And most people do not have the combined knowledge of both the real world political, economic decisions on one hand and the technicalities on the other, and therefore can combine those two strands of thought into perhaps one intellectual agenda.
Now, if we switch gears a little bit, I'm a quant macro manager, and as a quant manager, I like to measure things. I know how to measure data risk. I would love to know how to measure the systemic risk. What's the probability of something bad happen tomorrow?
I think that is basically not the best question to ask, if you allow me to say that to a podcast host. The reason is that you can approach the problem from two different directions. You can ask yourself, what's the chance of the S&P 500 dropping by 20%? What's the chance of interest rates going up by 100 basis points, or Bitcoin falling by 30%? You can find an infinite number of things that can cause you harm in the financial markets. And the problem is, there is an infinite number of things that can cause you harm. If you start taking this seriously, you risk paralysis by analysis. So the end result is most people in the system, I think correctly, end up ignoring most of this risk. The way to approach it is, there's an infinite number of triggers for a bad outcome, but only a very small set of fundamental behaviors that cause damage. And if you approach the problem from the side, so what is at the root of every single crisis? Ultimately, it is the self-preservation behavior of people like you. And what I mean is that, so at the risk of oversimplification, I would say most people who run hedge funds and banks, they maximize profits 999 days out of the year, and rules and constraints get in the way of them making that money. But 1 day out of 1,000, they maximize survival. Because when the system gets into a state of extreme stress or even a crisis, you no longer care about making a little bit more alpha in that world. You care about surviving the event. And what is your optimal behavior if you want to survive a stress event? You withdraw liquidity. You want all your funds to be at Bank of England or central bank reserves. You call in all your loans, you call all your standby agreements, you no longer supply liquidity in the market. And that withdrawal of liquidity by market participants is the main driver of extreme stress and crisis, and it's always been that way.
First of all, it's very good to know that I've been responsible for all world crises since the beginning of age.
I did not say it that way. I did not say it that way.
Okay, that's my take. And secondly, if everyone on the market is doing the same thing, it means that they have the incentive to do it this way, right? Yeah. So this is how the system is built.
Yeah, of course. I mean, we have to work with this. We have to work with the system. But to go back to your original question, is that if you understand how crises play out, if you understand that this is self-preservation of market participants, if you understand the reaction function of market participants, if you understand the reaction function of the authorities, then you can ask yourself, given my objective as an entity, given what I want to get out of my fund, and you have to look at yourself, you have to look at your clients and ask them, what do I want? How can I build resilience against that event, which I can describe fairly simply, because I know exactly what happens. Resilience against it at an acceptable low cost. And that means you insure yourself not against a 10 or 100 BP increase in the yield curve. You insure yourself against the behavior that causes extreme loss and stress. Therefore, you reduce the problem from something super complicated into something relatively simple and manageable. And to my mind, that approach to resilience is the one I would recommend to people who are concerned about large losses.
Okay, so practically what you're saying, if I understand you correctly, is that I should have a portfolio which is at all times resilient to the end of the world.
No, I'm not saying that at all. I'm saying you have to start by saying, if I was talking to you as a client, I will ask you, what do you care about? And you have to, maybe you don't care about the end of the world scenario, or maybe you do. I mean, everybody's different, but your portfolio has an objective. You start by looking at the portfolio, and then you ask yourself, given the portfolio, given the objectives I have, how can I insure myself against a broad range of disasters for the portfolio at the lowest possible cost? And by the way, and let's link this back to macro-pru. One of the biggest problems, I think, with regulations is they say risk is the same for everybody. You map everything onto value at risk or expected shortfall or CDS spread or something simple, which is appropriate for some but inappropriate for others. The first step to understand, to my mind, risk and thinking about large losses is to ask yourself, what do I want to get out of this with my portfolio? And then how is my portfolio robust against something that might happen at a cost that I'm willing to pay for?
I fully agree with this. But if we look at it from a practical standpoint, and if you are in this business of managing money, then it's not an absolute return game. It's eventually a relative return game. And then, as you correctly mentioned, there comes a time when you need to survive. And then everybody rushes through the same very narrow door. And typically there is no announcement. Nobody tells you in advance that, tomorrow morning we're going to have a systemic crisis. You just wake up and you are seeing the market prices gapped. And there is very little you can do about it.
No, I think your take is absolutely spot on. And if I just iterate on the points you make, is that this is one problem with regulations is the way we regulate is by looking in the rear view mirror and you say, how can I prevent the last crisis from happening again? I promise you two things. A, there will be a crisis, and B, it will be different in detail than any previous crisis. And therefore, if you excessively tailor your response to the past, you will end up making a big mistake for yourself. And of course, then you take your dual problem, the one you mentioned, which is that all the monitoring you have of everybody in the system. And of course, if you hire somebody to manage your money, you want to monitor them. That makes them increasingly short-term. So you end up with this conflict between you want long-term behavior for your money manager, but you monitor them short-term, which makes them behave in a short-term way. I mean, these are difficult questions, but there are better and worse ways to get at this problem.
Okay, but interestingly, I think you alluded a couple of times already to the problem of regulation of the market, to the problem of simplistic regulation of the market. I feel that you are trying to say that too simple regulation is not going to work because it narrows down the problem to some particular set of measures, which will be different the next time.
It's probably yes, but it's a bit more difficult than that. If you follow this global regulation game like I do, regulations always go to the lowest common denominator. They always go to the simplest possible approach. Because if it's global, you have to coordinate among the G20 countries, which is never easy. And if somebody hacks the regulations, finds a way around them, it might take a decade and a half to solve the problem. So regulations end up with the least important, lowest common denominator. And that is also why, to my mind, my idea of a more diversified financial system then you reduce the need for this minute monitoring of behavior. You reduce the need for specifying all these rules you have to follow. So you end up, this is why I think you end up with better economic performance at a lower cost and a more stable system. So a more diversified system is robust also against such regulatory problems.
But also, don't you think that if the system was less interconnected, it would be less prone to systemic risk?
No, the opposite.
The opposite. Why?
If everybody lives their own bubble and there is no interconnections, the risk is entirely local to you.
That's what I'm trying to say. Yeah.
Oh, sorry. Okay. So the more connections you build between people in the system, the higher risk becomes in the system.
Yeah.
So therefore, a globally interconnected financial system, is at a higher global risk than a locally connected financial system.
So shouldn't we just simplify the system, make it more compartmentalized, and ban any international investment? For example, you live in the UK, invest in the UK. You live in the US, invest in the US.
Okay. Now I'm going to give you two counter examples to this, and one of them can be personal to me, and the other is going to be global. My income and my pension is in the United Kingdom in British pounds. Therefore, it makes perfect sense for me as an individual for my private investments to be abroad, because then I diversify my own portfolio. So even if something bad happens to the UK, I am still insured. For the individual investor, it makes perfect sense to invest abroad and not domestically, since all of the lives are connected to the country they live in. So from an individual's point of view, this is wrong. And I would want my pension fund to invest globally, not locally, for the same reason. But let's do the geopolitical event. In the 1930s, that's exactly what happened. The world went into closed-off trading blocks, which did not interact with each other economically or financially. And while that might have reduced systemic financial risk for a short amount of time, that was not good for the world as a whole.
But on the other hand, if you take this example, let's go with that. You have a world war. And whether you're invested in the UK or in Germany would make some difference, of course, but not a huge difference. Of course, if you're invested in the US, that would make a difference. But nevertheless, I think what I'm trying to say is that in a good crisis, all correlations go to one. Everybody knows about that. And the US stock market, the UK stock market, the Japanese stock market are going to fall at the same time, all on the same day, by about the same percentage.
Of course, that's all correct, but I would take your point one step further. In a crisis, all correlations go to 1 or -1, of course. Everybody knows that. But why? To my mind, if you understand why that happens as an investor, or as a politician, or as a regulator, you can do your job much better than if you just take, we know all correlations go to 1. And my interest and my suggestion is to those in charge of things is to ask yourself why. And the reason why correlations go to 1 in a crisis is the 1 day in 1,000 problem I mentioned earlier. Market participants all go for safety in a stress scenario, perfectly sensible way of behaving, and you wouldn't want them to do anything else. But that's why correlations go to 1. So it all maps onto the same set of small fundamentals.
Yeah, absolutely right. But then I think you are contradicting yourself. You said that you don't really care about day-to-day risk, you care about a big event risk. And we know that in a big event, everybody will dash for liquidity.
Yeah, of course. Of course, but in day-to-day, they do not. So the day-to-day risk, say value at risk, volatility, CDS spreads, or VIX, or any of the other myriad measures of short-term risk, they are misleading and useless and can lead us down the wrong path. I mean, for most of these, or almost all of these, they send us a signal that is almost entirely irrelevant for how we should behave.
If we switch gears again, if we speak about artificial intelligence, which has been a popular topic recently, thanks to ChatGPTs of the world and other systems, quite useful, by the way. My impression is that the proliferation of AI is likely to increase the systemic risk rather than decrease it. What's your take on this?
The answer is yes and no. And by the way, I think, as a preface to this, I've done quite a bit of work on artificial intelligence recently. I even got my own GTP, which I call it the illusion of control. I've had my book and my other writings into it. And I would suggest anybody should get their own GTP and try to train it just to get a feeling for how it all works. It's a fascinating thing to do, and it doesn't cost that much money. But coming back to your question, what the issue with artificial intelligence and systemic risk is that it's really good at day-to-day decisions. And therefore, risk management, compliance, and all these myriad sort of low-level functions that your fund does, or the banks do, or the regulators do, the macroprudential or the micro aspect to regulations, I think can all increasingly be done by AI much more cheaply and more accurately and better than anything we have today. And this is happening very rapidly at the moment if you look at how banks spend. The problem is, as AI gets very good at dealing with routine events, where AI is no longer not good is where it doesn't have data. So if you take credit decisions or risk management, well, there's a lot of data. If it makes a mistake, the mistake is not catastrophic, and it learns from the mistake. This is how AI performs well. If you start thinking about, but this is all interpolation, it's all looking at things that already exist in the data. If you then ask yourself, how will the AI in charge of something behave when you look at outside the system at something new? If you ask either of you how you would behave in a crisis, you would draw on your personal experience. You would look at religion, ethics, history, sociology, economics, and everything you accumulated in your lifetime, and then you would interact with each other to make a decision. This is how human beings deal with things. They draw on their disparate expertise and knowledge, and that's how human beings can make often bad decisions, but also how we find a way to make very good decisions. AI cannot do that in current form. So the systemic risk from AI happens when you ask it to do something that is both really important, but in a domain where it has a poor understanding of. There's a phrase called AI hallucination, which is that it will always give you an answer if it knows nothing about it. And if you look at the dilemma for the financial authorities is that they will need AI to do the job. In the next crisis, the Bank of England will have to use AI to run scenarios on how to do liquidity injections or some other reactions. That's inevitable. But it find it really difficult to manage that process. So it is sort of, at least to my mind, the way to think about the systemic risk from AI is as we build in trust, as we see it performing increasingly well in increasingly complex situations, we get the AI version of the Peter principle when it gets promoted one level above its ability. But you will not know that until you're already in a crisis, at which time you can't turn it off.
By definition, when we're speaking about systemic crisis, we're speaking about the tails of the distribution. We're not speaking about the center of the distribution, which is very easy to estimate, and there is a lot of science about it. There is actually a lot of science about the tails of the distribution. There is extreme value theory. The problem with that is that it's very difficult to measure because the events happen so rarely, and it's very difficult to estimate those distributions. Here with the AI, we're seeing the same problem exactly. The AI can't estimate the tails of the distribution. At least we haven't seen it being able to do so. It's not in the data.
Okay, so just to come back to your point, I mean, I've been working on this problem all my working life, and I've written my share of papers on extreme value theory, trying to do exactly that. And I basically think that branch of mathematics is useless. I don't think it works. And the reason is, to my mind, is the day-to-day common events. We have so many of them that we can create a really good statistical model of day-to-day events. And then we say, magic, I know the distribution and I can just extrapolate into the tails, and I think, I can handle tail events. I think that's a very big mistake. If you look at why do some financial institutions survive and others fail? And just take Credit Suisse last year as a very good example that everybody now knows. It is, I think, ultimately just culture. Some institutions are really good at making the more or less right decisions again and again and again and again. And when bad things happen, they react quickly to contain the damage. Others do the opposite. So they push out the boundaries of the part of the distribution where they have control. That's what good risk management does. That's what good culture does, is to push you into the tails. But ultimately, if you want resilience against tail events, you have to go beyond data. The answer is not going to be in historical data. The answer lies elsewhere.
Don't you think that the use of the AI can lead to lower volatility in the market?
Absolutely correct, because if you use the language of finance, and this is AI, but this precedes AI, is we get very good at lowering volatility, but we fatten the tails.
Yes, that's the point. So in the tightly connected system in which we live, you reduce the volatility by introducing better tools, in this case the AI, then you actually fatten the tails of the distribution. So eventually what you're saying is that the AI contributes to an increase in systemic risk. And you said, when I suggested this, you said yes and no. So where is the no?
One cannot state confidently that AI will reduce or increase systemic risk because it depends on something we just don't know. However, we can look at the boundaries of where it leads to the right decisions, where it leads to the wrong decisions. That we can do. And it very much depends on how the financial authorities, how the Bank of England, the ECB and the Fed, how if they are able to embrace AI, they're going to use it to their advantage or not. Actually, 2 days ago, I put out a blog on exactly this question on how the authorities can take advantage of AI, sort of steps they could take to benefit from it, and what happens if they don't. So quite a lot of it just depends on the attitude of the likes of the Bank of England.
I think this has been a fascinating discussion, Jon. Very interesting. And I have learned quite a few things for myself, a lot to think about. Thank you very much for joining us.
The pleasure is all mine. It's been fun and interesting. I learned a lot from you also. I always find questions valuable, and your questions have been very stimulating from both of you, so quite beneficial. Thank you for having me on.
Jon makes it very clear that there is a significant difference between what the financial industry takes as a risk and what it should take as a risk, because there is a major difference between day-to-day volatility, which is easy to measure, and systemic crises, which are very difficult to measure, very difficult to estimate. However, he has a very clear view about what happens during those crises.
He was also very clear about what happens after the crisis, is that we're only trying to fix the last crisis and continue to design, and I thought he was brilliant on this, to try and design risk out of the system. And of course his point is this is ultimately futile. You are adding to cost, you're restricting innovation and growth. So an awful lot of macroprudential regulation is simply wasted effort. It may allow politicians to feel good, to feel they can handle the next financial crisis. But as he said, it won't be like the last crisis, and it doesn't tackle the central problem of herd behavior.
Don't you find it strange that it's impossible to explain to the voter that eventually it's he or she that foots the bill?
I think you call bailouts a middle-class benefit.
Yeah.
You know, in the end, it is the middle class, and in the end, it's the vast majority of people who don't have access to these kind of investments who actually have to pay in the end through higher taxes. So there's a moral issue to this as well.
Thanks for listening. This has been Capital Horizons.
So if you would like to see or learn more about Capital Horizons, please subscribe below.
From Michael and I, see you next time.